Good. I guess it's morning for both of us. Good morning, Greg. How are you doing today?
Morning. I'm doing awesome.
I'm glad we could get together to do another day, everyday trader, catch up and talk about what we're seeing in the market, share some insights on where we think things are going, maybe look at some individual stocks. But before we go too far down the road, thank you for everybody who's subscribed and those of you engaging in the comments. Please appreciate your feedback. Any comments or feedback, please post it down below. We're going to do a quick review of some major news stories that we're seeing in the headlines, some economics. And if you stick around to the end, those of you that listened to the last one of these, I provided a trade idea, which is doing quite well right now. I have another idea for a potential trade here that's very timely that I'm going to share with you at the end of this recording today. So what are your thoughts, man? What do you want to talk about first? We got a lot of news, a lot of economic stuff happening, tail end of earnings season with retail sales, economic data, and individual earnings coming up.
Let's talk retail. Let's talk retail sales. I mean, it kind of fits in line with a couple of big earnings reports that came out this week as well from arguably the country's, maybe in the world, but the country's two biggest retailers, Walmart and Target. And we saw two different results from these two companies reporting earnings. Walmart had a very positive earnings report. They beat expectation. They saw a lot of positive momentum. They filled their gap that they had from earlier in the summer from a trading standpoint. Target, on the other hand, missed badly. There's that chart of Walmart. You can see they've filled the gap. They've had a nice gap up yesterday, follow through momentum today. Target's the other side of the story. And I know when you and I were discussing a little bit before, I think this is the story of trade down. I think there's been enough retailers who are feeling a little bit of a pinch. Maybe the pinch is actually happening, or maybe it's just hey, everyone's telling us we're going into recession and we've got this inflation problem going on. So I got to try and save a little bit of money. So instead of going to Target this month, I'm going to go to Walmart instead and try to save a little bit of money here. Whether that, like I say, whether that's an actual dollars in my checking account decision, or whether that's a fear of preparing for the future because everyone's talking about inflation and recession, I don't know. I do know, listening to the CFO of Walmart this week after their earnings report, that he agreed that they are seeing a trend in of the shopping at Walmart where maybe the more upper middle class is starting to shop at Walmart where they haven't seen them in the past as they track people's individual income. Now, I love that story, and part of that just really disturbs me. How in the world do they know how much money I make when I walk into Walmart?
Yeah, I think data aggregation is interesting. The information they have on us is probably scary. I guess it don't have any privacy anymore. But yeah, I'm a little afraid of what they know. But this is a comment. This is Peter Bookvar's the book report. I'm a subscriber. I highly recommend. Peter, I think, is one of the best that are out there in terms of providing fresh insight. You probably see Peter on CNBC. Like I said, I pay for his newsletter. I recommend it. Maybe one of these days we'll get him on here to talk. I've fished with him a few times. He's a huge Grateful Dead fan, by the way. Peter's pretty awesome. But in here you mentioned Walmart, and he did have some quotes from the Walmart CEO from the trade from the earnings call. And definitely what you said is that they have seen some upper scale, some increase of people who have higher incomes coming in. What's interesting, I think you mentioned the tale of those two retailers, and what we're seeing from Target is a different story. Target pulling back. I think another good comparison is that goes along with the similar positive story from Walmart is that Home Depot earlier this week had really positive earnings, and Lowe's was today, right? Was Lowe's today?
Yeah, Lowe's is today. Lowe's is having
very
a nice move up
positive.
today.
So I think I think the narrative, you shared it, is that, people are, instead of maybe buying a new home, maybe they're putting money into their existing properties, getting that new gas grill, or remodeling their cabinets, or buying new floors. So maybe that is the story. I did see a report that retail, well, not retail, but consumers are tapping their home equity lines. They're seeing an increase in home equity access. So people are using that money probably to do improvements rather than. So I think that goes hand in hand with those. But we definitely have a dichotomy of what's happening in the retail space. Overall, from an economic standpoint, retail sales was reported this morning, and from advisors' perspective, which is now part of Vetify, this is Jill Maslinski does a great job, I think, of presenting some of this data. Great charts if anybody is interested. I always like going here, but looking at retail sales was up. I think the forecast was 1%. That was the consensus. We're up 1.3%. So that's part of that is due to inflation that we're still seeing. Gasoline sales, as we know, were up over last year. I mean, that's a significant, it's not a surprise to anybody that they're up 17.8% over 2021. While food services and drinking places are up 14%. So we're seeing some, I wouldn't say it's all negative news. It's just sort of shifting around in the retail space. Of course, this is maybe not a good thing from a broader perspective of the Federal Reserve and what we're going to see happening there, because we did see some discussions about inflation, and you mentioned Ester George's comments.
Yeah, I was going to say, I think that's the real reason why the markets are down today, or at least we're back. I think the Dow is actually up right now while we're talking, but the S&P is down solidly, down 21 points. NASDAQ's down 138 right now, down about 1.25%. And so we're back in that mode of selling off high risk, high tech, which was the big bounce the last 2 weeks, right? Those are those stocks that really bounced, but we're back in maybe inflation mode. And I think that does come from comments from Ester George, specifically Fed Chair Timrose.
That was a joke for everybody.
It was a joke, yes.
Yeah, Nick Timrose is a reporter for the Wall Street Journal, although it's been said that he is uncanny. He is batting 1,000 in terms of his prediction of what the Fed is going to do. So I think it's pretty well known that he's got some inside scoop there. So and Nick did have a. Oh, that's not. I'm sorry. Nick did have a piece out too. Or that is, this one isn't Nick's. Yeah, this is Nick's piece. Yeah.
Yeah, and so the comments there are really talking about that the Fed, and specifically Ester George, saying she does not feel that we can control inflation without sending us into recession. And the reason why she thinks that is because we have such an overheated, tight job market right now. And that the recession will be the only thing that may slow down this job growth, which is what they really do feel at this point is starting to drive this inflation, is the wages that are going on in this tight labor market. So if she's right, I think what that means is I still think we may have seen peak inflation. I don't know that necessarily she's saying that it's going to continue to increase, but that the only way to get it to come down is to get this job market to loosen up. And I think the only way to get the job market to loosen up is to send us into recession. That's kind of what she's saying. Is that otherwise inflation is just going to be sticky. It's going to grow, to use the right there on the top of the article, it's going to grow entrenched, and we're just going to get used to seeing, high single digits inflation, which is going to crush the middle to lower class if that happens.
Yeah, so we're talking about here, and this has been going on for a while, is the concern about wages, which is, hits close to home. Nobody wants to think about making less money, but that's what we need to see is wages come down. It's hard to do that without pushing ourselves into a recession. It's tough news. to swallow. And I know individually it's personal, but the Fed is going to do what it can to get wages under control. And I'm sure you saw Waller's comments in Australia over the weekend that I can almost hear his words. I didn't hear the speech, but I read the commentary. The market is way, way, way ahead of themselves in thinking that the Fed is going to back off. So we're probably looking, and the last time I checked, I haven't done this in a bit. I like to look at it. I almost look at it every day as the Fed watch tool, Fed funds tool, to see where we're forecasting for December. And yeah, so we're honing in on it. We're at 375 right now. This is a 50 basis point hike. So we're pretty locked in. It's close to an 85% probability that on December 14th, the Fed will raise 50 points. And I think we're going to be in a series of 25-point increases going forward there. We can look at the long-term terminal rate. And I think we're going to see this be very volatile, right? Last week or a couple of weeks ago, the terminal rate was in the fives. Now they're showing the terminal rate 475, 500. This is where the Fed peaks out and where their Fed funds rate ends. I think it's going to be very data dependent, and it's going to move markets along. We're going to have to keep an eye on this going forward. But yeah, certainly getting wages under control. We did see some headlines this week about tech companies with layoffs. Certainly the drama that's happening at I'm not sharing my screen right now, am I?
At Twitter, that's all right.
Okay.
No.
Here's the Fed funds rate. So this is for December. We're looking at a 85% probability of a Fed funds rate of 425 to 450. We're at 375 to 400. That's a 50 basis point hike. And then showing the probabilities here, this is showing what the terminal rate would be, estimating where does the Fed end up. This blue number is sort of where the market is saying the highest probability is of us being, and we've been in the fives.
They're low. I think we're in the fives, Eric. I mean, maybe the market's right. I don't think they are. I think after knowing our conversations we've had with Waller, looking at the strong job market, I don't think the Fed, now they may not be doing big chunks anymore. This December meeting may only be maybe a 50 basis point hike, and then maybe we move to quarter points, but I think they're going to be in quarter point moves every meeting indefinitely until they really see some data of inflation, not just peaking and slowing down, but actually coming down drastically. And so I think the market's not pricing in enough move. I think we could see 5.5, maybe even upwards of 6 before the Fed reaches its target.
Yeah, I think to me, trying to forecast where the number is going to be is difficult, but knowing what's going to matter, I think the market will place a lot of focus on data, of course, inflation. And we saw a pretty good inflation report this week with the PPI coming down. But I think we're going to have a lot of focus on, especially now you're hearing wages. So it's been inflation and wages. And I think the wages and employment situation is going to start the narrative. You can feel the narrative change among the Fed speakers that are looking more at this. Since I got to give credit to Sam Rines for putting out this notion of vacancies, unemployment versus vacancies, and looking at that ratio. So hopefully with some of these either job freezes or hiring freezes and layoffs, I don't want to be morbid, but if the Fed gets a signal that we're going to, and we'll see it through data, by the way. So keeping a look at anything related to employment, I think is going to get a lot more attention. So tomorrow we have jobless claims at 8:30 a.m. So Thursday, November 17th. That's going to get a lot of attention, I think. If it comes in line, probably not so much. But if we get unfortunately more jobless claims than we expected, we'll probably see the market rally on that and look to the Fed watch tool to probably change. So I think our shift in focus and what we pay attention to now needs to be more on as much as on inflation, but I think employment is really going to start taking priority there.
I agree with that. And just to throw some numbers on there, I mean, last week you mentioned some of the big headlines, from Meta's 11,000, cut, to Twitter laying off 50% of their staff, and now people being laid off in real time. That's been the entertainment over there at on Twitter. Tesla job cuts, Snapchat, Shopify. You go down the list of a lot of the names that really drove this strong job market in 2020 and 2021 coming out of the pandemic. They're the ones that are laying people off right now as well. So maybe it'll come first part of next year. We'll see. We'll see. Until then, yeah, markets. Let me talk big picture market right now too. I mean, last week we had a huge up move. I think the biggest move we've had since coming out of the COVID lows in 2020. We had a big week last week, and we can't go straight up either. We have to, if we can get a week this week that just kind of consolidates, maybe we get a little down move and then maybe some positive news towards the end of the week to build some momentum on. That's what we need to continue a rally into the end of the year. If we go straight up, we're going to come straight back down again because we'll get overbought. And arguably, we did get overbought from the market standpoint last week. And so I think a week like this, if we can just maybe go slightly lower and still have some bids show up, and maybe have some leaders like, Apple and Google. Google's actually green today. Goldman Sachs, if we can have some financials step up and lead the way of showing that there's still some interest in buying equities right now. This is what healthy bottoms actually look like, rather than straight screaming up, because that means we're going to come straight back down.
Yeah, I think this key level, a psychological level of 4,000, if we can get the S&P 500 to get a close above 4,000, I expect that we're probably going to see some resistance, as you said, consolidation around here. Not shown here, but we are above the 50 and the 100-day moving average. We're still below the 200-day moving average. So we see where that heads, but I think this 4,000 level is seen as a key level of support. I'm not showing it here, but Tier 1 Alpha reports the dealer gamma, and we've switched from negative gamma to positive gamma, which tends to help take some of the volatility out of the market. I think there's a lot of reasons for that. Putting some major events like the earnings or the election now is finally behind us. Hopefully we can be done with that drama for at least, I don't know,
at least another 2 years. Yeah.
No, 2 years. In 2 years, we're going to be in the thick of it. It's
that's true.
Democracy is on the line.
We got a year. We've got about a year until we get the primary.
The very survival of democracy is what's in front of us. And I don't know if you saw last night, but Trump did announce, of course, that he's going to be running. So
I did.
Yeah, it'll be entertaining nonetheless. So hopefully we can take politics out of it for a while. I think Thomas Massey had a very interesting tweet this morning saying that you can expect the House to pass two kinds of laws, which I think was very wise. One is signaling. So there'll be a bunch of laws that will be passed and either be not make it through the Senate or get vetoed by the president that are just symbolic in nature, which is a waste of resources, or there's going to be budget bills passed. So that's the only thing that's really going to make it out of Congress for the next 2 years. Good news is that Biden did front load his the agenda for the first 2 years. I think as long as we don't get any major regulation, we hear CEOs talk about regulatory uncertainty. I don't expect that we're going to have any major laws passed. Whether that's good or bad for the country, that's not what we're talking about here. The perspective is the market. So I think from the fact that even though we don't have as much, we didn't get this red wave that we expected, but we do still have what's pretty much a deadlock Congress. And I don't think everybody's going to be focused on the election. Nothing's going to get done for the next 2 years. So it's one less thing for the markets to worry about. We still need to worry about inflation and unemployment going forward. And do we potentially have a recession? But at least one of those big things is out of the way. And there's a lot of reason to believe the best years is the third year of a president's. Historically, there's only been one down third year of a president. I think that's 1931. So historically, this has always been somewhere back then. Historically, this year. So I think the third year of a president and we've just entered it, has historically been good. So let's hope that history plays out going forward. That's what I'm watching.
Hey, I have a question for you before you get to your trade that you wanted to share. And I know I don't want to dive too deep into this because it is so much speculation and unknown at this point with the fraudulent activity that went on with at FTX. But is this drop in crypto that we've had over the last year potentially systemic in nature? Is there systemic risk from the cryptocurrency collapse into the broader economy? Do you have an opinion on that?
You and I both sat at an economic event where the Fed asked the question, and I think Waller was very sincere and asking the question, where's the leverage? Where is the leverage in the industry? What are we missing? What's the symbol for Bitcoin?
BTC.
BTC.
Switch to CNT.
I thought it was BTC USD.
USD. Yep, that's what it is right there.
Let me go back there. He's asking where the leverage is, and the consensus is in the room was they're not seeing it in any of the public sort of institutions. That the issue is that it's probably in private equity. And I think that this story that's happening with these crypto exchanges is that a lot of the private equity money was tied up in these exchanges. I mean, I had members of Options Animal telling me, hey, I'm getting 15% on my money. Like that, just loaning your money just sounds crazy. And of course, if you go read, none of this money is FDIC insured, and really easy to get caught up in that herd mentality. It reminds me of the people who followed James Cordier and were doing naked calls on natural gas. Making 20-25%. There's a ton of risk in there. If you're making 15%, there's, read the disclaimers. And so my concern, long answer to your question, is this systemic? I'm afraid that it's going to play out in private equity, that we're going to see. And this is, you see anecdotal pieces on Treasury that VCs are talking about their treasuries being frozen or what potentially wiped out. That's an important part of the economy because it invests in startups, and I don't know how that all plays out. As far as systemic in nature, is this gonna bring down a Goldman Sachs or Morgan Stanley or Credit Suisse or somebody like that? I don't think so. I'm not an expert in those areas, but at least from what I'm seeing is that their exposure is limited. But I do think that there will be some severe consequences that play out, and we're certainly seeing it in the price here of Bitcoin.
It'll be interesting to see how many hedge funds get pulled into this too. I know Scaramucci's hedge fund obviously had big exposure to FTC or to FTX, and that's one example of a hedge fund. But yeah, I think you're right as well. I don't think, opinion wise, I don't think it's going to be tied to too many of the publicly traded the banks. I don't think we're going to see liquidity issues there. The question will be how much of the confidence in cryptocurrency has been absolutely destroyed, of that it's a legitimate asset right now because of this fraud story. And maybe it's not a legitimate asset. Maybe Charlie Munger is right. Maybe it's all a big.
Well, Warren Buffett said I wouldn't take all of the Bitcoin in the world for a dime. And the argument is that if you owned it all, it's not worth anything. The only reason there's value is that somebody else thinks it's worth something. And that's the same with any commodity: gas, oil, silver, wheat. It's only based on the value that it has. Some of those actually have, floors because they have actual physical uses that they can be used for things. Bitcoin doesn't actually have much. You can't use it to make anything. It doesn't.
I'd probably throw Bitcoin and all of crypto more in something like fine art. I mean, what makes a Van Gogh painting worth?
Now you're talking about Ben Hunt, right? So, by the way, he has been absolutely lit. You seen him? Yeah, his Twitter's been on fire. If you're not, Epsilon Theory is. I love Ben. He's one of the smartest people in the world. but that guy operates on a different frequency. He comes up, he is like his thinking cycle is so fast and his insights are so amazing. I'm at awe listening to him and his perspective. I really appreciate
I
Ben's
agree.
perspective.
I have to agree. One of my favorite follows on Twitter for sure.
Let's and the thing, I mean, he is completely passionate about doing the right thing. The guy has a lot of integrity, and I think he plays right down the middle too. On either it's hard. Is he liberal? Is he Democrat? Or is he Republican? Is he conservative? Or he's straight down the middle. I think he operates at a based on ethics. I think he's really a smart guy. So he's been absolutely on fire with what's happening and he's the way I mentioned his name because he calls crypto as good art. It's art, it's beautiful, has value based on its perceived values. Yeah, I have my story goes back, and I think I've probably shared this, but I have 3 Bitcoin that are with Mt. Gox. So I was one of these people that housed my Bitcoin with an exchange. I didn't understand. This is 10 years ago or 2013, 14, when it was $300. I'm like, yeah, I'll put $1,000 in this, buy 3 Bitcoin. What's the big deal? And, everybody now is like, oh, you're an idiot. You should have kept your keys. And the thing is, I probably read that someplace. And I do remember saving them someplace, but I also remember people saying, don't make sure that you put it where nobody would find it. So I probably gave it a name, like I think I saved it as a PDF on a hard drive somewhere and gave it a goofy name. And I have tried to try and find, I probably, called it book.1.xls or something, something that would be, and I hit it so well that I can't even find it. So it hurt more when Bitcoin was at 60,000, when it was 60,000 and I had $180,000 that I couldn't find. So now it doesn't hurt as bad.
Yeah. Now it's only, 40,000. Right.
Easy come, easy go.
Right. All right. What do you got trade wise?
Oh yeah. So the idea that I had for a trade for people is when option prices are based on more than stock price. Stock price affects only the stock price, right? People who trade stock focus heavily on stock price. At Options Animal, we teach an approach of doing our due diligence. We look at stock price, not only stock price, but time impacts options, and so does implied volatility. And a lot of times implied volatility, with some equities, it's not significant. Sometimes it is. I always tell people, if your option trade didn't make money or did make money and you don't know why, the reason probably had to do with a change in implied volatility. And that this is experience for me making trades on especially credit trades. And like, hey, this credit trade should have made money. Why didn't it? Or maybe doing a straddle and strangle over earnings and expecting that you're going to make money and you don't. And what's probably happened is there's been a big change in implied volatility. So Footlocker has earnings coming up here in a little bit. And this is a stock chart of Footlocker. This is 2 years, but if we go back 4 years, this stock gaps, and there's nothing in the technical indicators. Technicians are great. If you show them this chart, they'll go back and they'll show you the zigzag indicator or the triple Lindy or something that would have told you this was coming in hindsight. But the truth is there's nothing in this that would indicate a gap is coming. And the reason is because the stock is consolidating, waiting for earnings. And that's why this company gaps every 3 months. There's a big gap. If we flip over to ivolatility.com and look at the gold line, which is the implied volatility index, looking out 30 days of the price of options, we see like a sinus rhythm, the heartbeat going up and down 4 times a year. So it's quarterly earnings, options get expensive, and then the stock gaps or doesn't gap, does what it's going to do. But what we're going to see here, if you just go back, if I asked even the most novice person to look at this chart and say, where do you think this gold line is going to be next week? Do you think we're going to be in the 60s or do you think we're going to be in the 40s? And sometimes we do get some weird things that happen, but I would put my money that implied volatility is going to be down at 40. So what
Yeah.
I'd want to do is place a Vega negative trade, a trade that makes money from a volatility crush, and a strategy that is really counterintuitive would be a credit spread. And so something like a bear call, so selling a call out of the money, buying a call, selling a put out of the money, buying a put out of the money. That would be an iron condor, which is crazy. If you know that you're going to get this sort of gap, why would you do an iron condor? And the reason is taking advantage of this big volatility crush. Now, I would prefer not to do the bullish side, because I think you need to think about how you'd fix this trade if it went against you. So the strategy that I'm looking at is selling a 30, buying a 25, going out about a month on that expiration series. Worst case, I could end up taking ownership of the stock, getting assigned, which is not a big deal. There's plenty of premium for being able to sell calls on this. So this is the strategy that I'm looking at right now, is a bull put, what's known as a bull put before earnings. This is not for novices, and I wouldn't do it if I wasn't willing to take ownership of the shares. But I think it's a pretty interesting trade that would benefit from what could be, if it's a moderate move down or a big move up, the trade is going to just do very, very well from the stock movement, from time going by and volatility dropping down. What the risk is if it goes down, I would allow the short put to get assigned. I have a long put to give me protection, and I would manage that trade. So it's a strategy I'm comfortable with. I've done the same sort of thing, even on Netflix. And it could take a while to make the money back. I think it's a high probability trade, but there's a lot of moving parts. So definitely not for novices. So that's my trade idea today.
Cool.
Thoughts?
I think it's a good one. IV crush is a pattern that is easily predicted, as you said.
Yeah.
And if you trade around it and have your exit plan defined around it, every month you can find them. Yeah.
Yeah. You can find these sort of trades out there. Some equities don't have this sort of pattern. Netflix is one that does. And you're sort of trading against the crowd who's out there trading. They're either going to trade it bullishly or bearishly. There's been a lot of news leaking fundamentally about Footlocker, and going along with some of the retail news that we've seen, looking at somebody like Lululemon that missed. I expect that Footlocker is probably going to miss. And there's been a lot of news stories about that. They're probably going to miss earnings. So it's probably priced in. I don't know that we're going to get a huge move down. And if we do, I wouldn't expect it to be much below 25. And in which case, I'm going to put it 25. That's going to protect me. Absolutely would not do a naked put strategy. That would be, I think, a bad trade, because we could definitely see a gap down to the teens. And having that put at 25 is going to give you a lot of protection. Well, we went a little longer, but I wanted to share that with people as a potential idea for a trade. And for those of you that are interested, we're going to work on hopefully bringing more ideas like this to you on a daily basis. That's all to come in the future.
Yep. Okay. Thanks, man. It's good to talk to you again.
All right. We'll get this uploaded. We'll talk to you later. See you later, Greg.
See you guys.